President Trump says he is getting close to a trade deal with China. Meanwhile, Mexico's President Sheinbaum says she and Trump agreed to extend the trade deadline for a few more weeks. EJ Antoni joining me here in New York. Trade deals in Asia, the possibility of a deal with China, and now this is the extension of the trade agreement with Mexico. Does all of that trade news, does it add anything, any growth to our economy?
Future growth, absolutely. I think that's part of the reason why we're seeing the market do as well as we are, right? You're seeing progress in the trade deals. You're seeing a lot of the potential trade wars essentially being called off. And every time that happens, I think the market's going to continue taking off. And particularly in the case of a country like Mexico, where even though, okay, we don't have a deal yet, because their government is clearly negotiating in good faith, the president is more than happy to continue extending the deadline on these talks.
Let's extend this into next year. We've got tax cuts coming, large refunds coming. I believe that's the case. We've got regulation being cut back. We've got corporate profitability, not corporate profits, but the tax on corporate profits going down. We've got trade deals that look to be successful. Can we get 4% growth at any point next year?
Oh, absolutely, particularly because of the middle point you mentioned there, the deregulation. If we go back to the first Trump administration, for example, Stu, the president asked a lot of different businesses, ranging from very small businesses to some of the largest corporations in the country, and he asked what was more helpful to you in terms of growth, in terms of profits, in terms of hiring? Was it the tax cuts or was it the deregulation? Every single one in that entire group said the deregulation, and they're, I think, doing it faster this go-around than they did in Trump 1.0.
4% growth, not much inflation. Trump and the Republicans are a shoo-in for the midterms. What say you? Yeah, you're going to agree with me.
I'm no political scientist. I'm a monetary
scientist.
You're
a Trump
guy. I will say that formula makes sense to me.
Okay. The fund billionaire, hedge fund billionaire, his name is Ray Dalio, you know him. He says that the bottom 60% of workers are becoming dependent on the top 1%, the highest earners. There's a dependency there. What he's talking about here is income inequality. Should we do anything about income inequality? And if so, what?
Oh, sure we should. We should stop causing it. What's the biggest driver of income inequality today? It, frankly, is the central bank devaluing our currency so that you get these massive increase in asset prices, whether that's equities, whether that's housing, whatever the case may be. So people who already own those assets get that price appreciation, and everyone else does not. And what do they get? They get the inflation. They get the higher cost of living. They see the value of their earnings, the value of their savings all go down.
So growth is the way to get away from this extreme income inequality.
Real growth, exactly. Real growth, not just simply inflation that drives up the nominal numbers.
What do you say, Murph? How do you do you want to get rid of income inequality, and if so, how do you do it?
Well, I think it's always going to exist by definition in a capitalist society. So you have a guy like Ray Dalio, who, like myself, born in Queens, and he just has done extremely well for himself. I think the key to this, the reason it doesn't bother me, is that the next person in Queens, the youngster out in Queens, he can become the next Ray Dalio. So we have the opportunity in this country, although there's inequality at some point, you can become a hedge fund billionaire, you can become a superstar TV host, you can do whatever you like in this country. So you need the people at the top for people to strive for and to knock off and to become better than. So I'm all for it.
Me too. All right, Murph, thanks a lot. Thank you very much, EJ Antoni.